Joining us to talk about Zynga's numbers is Hamadeh, CEO of PrivCo, a firm that researches non-publicly traded companies. He joins us now from New York. So, Sam, 95% decline in quarterly profits, user base shrinking, decrease in sales of ads and virtual goods. All of this sounds like very bad news, but just how concerning is this to you?
Well, I think that if you're an investor in Zynga, or a venture capital investor or an employee with stock options, the last thing you wanted to see last night was an IPO amendment. What you wanted to see was an IPO pricing. Companies don't file to go public so that every 90 days they can spend a couple $1 million updating their quarterly financial statements with nothing to show for it. So clearly this was a disappointment for anyone who was invested in Zynga. It was a disappointment for the IPO market for private companies looking to go public. And, if the numbers were blockbuster, perhaps, but they weren't, as Cory said.
Now, Zynga's putting the chances of an IPO at 75%. What's your assessment of the actual chances here, and how much is this slowing growth going to slow down the IPO?
Well, I think Zynga has some things going for it and has probably more things going against it. Number one, the company, we have to remember, this company has only been around for a few years. It essentially was a gaming platform created for Facebook. And Facebook itself never hit really major user traction until about 3 or 4 years ago. So we don't have too many historical comparables on which to measure this company. So there are a couple of things that are concerning here. One is that the number of active users have gone down. They did go down from 67 million in the first quarter of last year down to 62 million in the first quarter of this year. I guess a lot of people wondered if that was maybe a temporary bump in the road. But when they came out with numbers last night, they went from 62 down again to 59. And so I think what you're seeing essentially is a company that was built on the Facebook platform at a time when there really were very few other gaming options. Essentially, we're the only game in town, so to speak. And for a couple of years, they had...
Hey, Sam?
Yes.
Oh, sorry, man, I'm jumping right in. You guys have done some really good accounting work on this and dug into it. And noting a slowdown, which is notable. But from a profitability standpoint, and the revenue recognition is somewhat conservative still, this is a really big, powerful business, wouldn't you say?
Well, look, there's no question that compared to many other companies that have filed for IPOs, and frankly, even ones that have gone public like Zillow, that Zynga is a very profitable company. And unlike other companies like, say, Groupon that frankly face an imminent liquidity crisis, or even Pandora, which was bleeding money month after month for content licensing fees, Zynga actually, to their credit, does generate cash, does make money. The company has over $900 million in cash, as you said. So this is not a company that has to go public tomorrow or 6 months from now or even a year from now.
Yeah, I mean, that's one of the things about this. These guys are throwing off so much cash. You wonder, we just had Doug McMillan talking about Living Social, delaying plans for an IPO. We obviously, the market really take a dump today. Do you think that these guys throwing off cash like this might be better suited just to wait?
I think the answer is yes. However, the problem is that they did file to go public. So what they essentially revealed, which is not surprising, that there are a lot of very short-term, impatient investors in this company, and probably Mark Pincus himself has a very short-term time horizon. And it does indicate that internally, they see the metrics, they see the direction, they know that the monopoly, of social games won't continue. I mean, just last month in August, offline traditional electronic games maker Electronic Arts introduced Sim Social. They're essentially their social gaming of SimCity. Within 2 weeks, surpassed all of Zynga's games to become number 2 most used game on Facebook. So I would say absolutely, there's no question there's a company that generally, in a normal environment, would have been better off staying public. But then you don't spend $10 million filing an IPO and spend $2 million a quarter updating that IPO with quarterly numbers.